So it's 11:30 p.m. on a Tuesday, and you're doing the thing again. You're on Zillow or Redfin, scrolling through listings in a neighborhood you actually like, and you see it. It's a 3-bedroom, 2-bath house that looks okay. It's not a mansion. It's not a mid-century modern masterpiece. It's just a house. But then you look at the price tag, $500,000. And here's the kicker. The description calls it a perfect starter home or a handyman's dream. You look at the photos and see laminate countertops from the George W. Bush administration, beige carpet that's seen better days, and maybe a backyard that's essentially a patch of dirt. You start doing the mental math, thinking about your salary, your 401k contributions, and that looming car payment, and you realize something feels fundamentally broken. But today, we're going deeper. We're going to look at the gears behind this machine, from the Federal Reserve to the S&P 500, to figure out why the American dream is starting to feel like a high-stakes escape room. My name is Troy, and I spend way too much time thinking about the intersection of macroeconomics and personal freedom. If you're someone who feels like you're doing everything right, working the corporate job, keeping your credit score in the mid-700s, and skipping the expensive lattes, but you still can't seem to afford a basic roof over your head, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today, we aren't just talking about house prices. We're talking about your life, your time, and the financial traps that are specifically designed to keep you running on a hamster wheel until you're 65. Look, we have to start with the why. Why does a $500,000 house feel like a luxury in 2026 when it used to be the price of a small estate? To understand that, you have to understand what the Federal Reserve has been doing over the last few years. We've moved out of the era of free money. Remember those 2.5% or 3% mortgage rates from a few years back? Those are gone. They were an anomaly, a historical glitch. Now, we're looking at a world where 6.5% or 7% is the new normal. But here's the problem. While the interest rates went up to fight inflation, the home prices didn't actually take the hint and drop. Why? Because nobody who locked in a 3% rate wants to sell their house and move into a new one at 7%. It's called the lock-in effect, and it's created a supply desert. Now, you might be thinking, Troy, if supply is low, surely I just need to save more, right? Well, let's look at the statistics. Since 1990, the median home price in the U.S. has skyrocketed by about 400%. During that same window, the median household income has only crawled up by about 180%. We are living through a period where the cost of the entry ticket to the middle class is growing twice as fast as the wages that are supposed to pay for it. This isn't just a you problem, it's a structural affordability crisis. We are asking people making the median income of $84,000 to buy homes that are 6 times their annual salary. In the 1970s, that ratio was closer to 3 times. We've literally doubled the difficulty setting on the American dream, and nobody gave us a manual. Let's get into the nitty-gritty of the money. Everyone tells you that you need 20% down. On a $500,000 house, that is $100,000 in cold, hard cash. Now, let's be real. How many people in their 20s or 30s have $100,000 sitting in a checking account? Most Americans have less than $8,000 in total savings. So what do? You do what the mortgage broker suggests. You put down 3.35% or 5%. You think, great, I'm in the house for $25,000. But this is where the poverty taxes kick in. The moment you put down less than 20%, you get hit with PMI, private mortgage insurance. Now, I want you to listen closely. PMI does absolutely nothing for you. It doesn't protect your equity. It doesn't help you if you lose your job. It is literally an insurance policy that you pay for to protect the bank in case you default. You're essentially paying $200 to $400 a month for the privilege of not being rich enough to have $100,000. Over 5 years, that's $18,000 of your hard-earned money just evaporated. But here's the part most real estate agents will never tell you: the opportunity cost. If you take that $100,000 or even the $25,000 and you put it into a Roth IRA or a low-cost S&P 500 index fund, that money is working for you. Historically, the S&P 500 returns about 10% annually. In 10 years, that $100,000 could be $260,000 without you lifting a finger. When you put it into a house, it's locked in the walls. You can't eat your drywall. You can't use your kitchen cabinets to pay for a medical emergency. You are house proud, but cash poor. Here's what most people don't realize about the $500,000 house. The $2,800 mortgage payment you see on the Zillow calculator, that's the teaser rate. It's like the price of a printer before you realize the ink costs more than the machine. Let's talk about the cash leakage of homeownership. First, there's property taxes. In some states, you're looking at $6,000 to $10,000 a year. That's nearly $1,000 a month just for the right to live on the land you supposedly own. If you don't pay it, see how fast the government reminds you who the real owner is. Then there's homeowners insurance. With the climate changing and natural disasters becoming more frequent, insurance premiums have gone vertical. We're talking $300 a month easy. And we haven't even touched maintenance. The 1% rule says you should save 1% of the home's value every year for repairs. On a $500,000 home, that's $5,000 a year. That's $416 a month. Think about that. You are paying $400 a month just to prepare for the day your HVAC dies or your roof starts leaking. When you add all this up, the mortgage, the PMI, the taxes, the insurance, the maintenance, your affordable $2,800 is now $4,400. To afford a $4,400 monthly housing cost without being house poor, you need to be clearing roughly $187,000 a year gross. That puts you in the top 10% of earners in the entire country. Do you see the math here? The starter home now requires a top-tier salary. This is where it gets really interesting, because the banks will still approve you if your debt-to-income ratio is under 43%. They will look at your $120,000 salary and say, sure, you can afford $4,300 a month, but the bank doesn't care if you're eating ramen noodles every night. They don't care if you can't afford to contribute to your 401k or your Roth IRA. They just care that the check clears. Let's do a deep dive into a real-world scenario. Let's look at a couple we'll call Mark and Sarah. They're doing great. Combined, they make $160,000. They've got the college degrees, the white-collar jobs, and a solid credit score. They buy the $500,000 house because that's what you do, right? Their take-home pay after taxes and a modest 6% 401k contribution is about $9,500 a month. Sounds like a lot until the bills hit. They pay that $4,400 housing cost. They've got 2 car payments because in the U.S., you can't live without a car in most places. That's another $1,000 with insurance. They've got $600 in student loan payments because those degrees weren't free. Gas, groceries, utilities, and cell phone plans eat up another $2,000. Suddenly, they're left with $1,500 for everything else. Everything else includes clothes, doctor visits, birthday gifts, and maybe, just maybe, a dinner out once a week. But here's the psychological trap. Mark and Sarah look successful on Instagram. They have the house, they have the lawn, but behind the scenes, they are living in a state of constant low-grade terror. If Sarah gets laid off or if Mark needs a root canal, the whole house of cards collapses. They are house poor. They're working 40, 50 hours a week to pay for a house they're too tired to enjoy and too stressed to leave. This isn't the American dream. It's a gilded cage. This is the myth I want to debunk once and for all. You've heard it from your parents, your uncle, and every real estate agent. Renting is just paying someone else's mortgage. You're throwing money away. Is that right? Let's look at the unrecoverable costs of homeownership. When you own a home, you are throwing away money on mortgage interest, which is front-loaded in the first 10 years, property taxes, homeowner's insurance, maintenance, selling costs, the 6% commission you pay when you leave. When you rent, your rent is the maximum you will pay for housing that month. When you own, your mortgage is the minimum you will pay. If you rent a nice apartment for $2,500 and invest the $1,900 difference into the S&P 500, you are often building wealth significantly faster than the person who is struggling to pay a $4,400 mortgage. Renting isn't throwing money away, it's buying flexibility. It's buying the ability to move for a better job. It's buying the ability to let the landlord worry about the $8,000 roof repair. So, Troy, what do? If the system is rigged and the math is broken, do I just give up? Absolutely not. You just have to play a different game. Here is the strategy I want you to consider. First, stop looking at what the bank says you qualify for. The bank's qualified number is the edge of a cliff. You want to stay at least 20 yards back from that edge. If they say you can afford a $500,000 house, start looking at $350,000. I know it's not as Instagrammable. It might be smaller, it might be further out, but that $150,000 difference is the price of your mental health. It's the difference between crying over a broken dishwasher and just calling a repairman and moving on with your day. Second, prioritize your liquid wealth over your paper wealth. In the U.S., we have incredible tax-advantaged tools like the Roth IRA and the 401k. If buying a house means you have to stop contributing to your retirement, you cannot afford that house, period. Compound interest is the only thing that can outrun the inflation we're seeing in the housing market. Don't sacrifice your future self for a granite countertop today. Third, consider the live-in flip or house hacking if you're single or a young couple. Can you buy a duplex? Can you rent out a room? If you can get someone else to pay $800 of that $4,400, the math starts to look a lot more human. It changes the dynamic from you serving the house to the house serving you. At the end of the day, a house is just a place to sleep, eat, and keep your stuff. Somewhere along the line, we turned it into a high-stakes financial instrument that defines our worth as adults. But let me tell you something. There is no trophy for having a $500,000 mortgage. There is no award for being the most stressed person in the suburbs. Real success, real try-hard investor success, is having options. It's having the freedom to walk away from a toxic job because you have 6 months of expenses in a high-yield savings account. It's being able to sleep through the night because you know that even if interest rates go to 10%, you're going to be just fine. The housing market might be broken, but your personal economy doesn't have to be. Run your own numbers. Ignore the social pressure. Be the person who says, no, that doesn't make sense for me right now. Because the smartest move in a rigged game is often choosing not to play until the odds are in your favor. If you've made it this far, you're clearly serious about your financial future. Do me a favor, comment below with the word freedom, so I know who's actually listening to the math and not just the hype. Make sure to subscribe for more deep dives into how to actually win in this economy. My name is Troy, this is the Try Hard Investor, and I'll see you in the next one.